All right, let's jump right in. You know when you pick up a company's annual report, have you ever stopped to think about the story behind those numbers? Because there's this weird, fascinating little pocket of time. I like to call it a financial time warp that happens after their year officially ends, but before you and I ever get to see that report. And trust me, what goes down in that gap, well, it can change absolutely everything.
So, to get us started, I've got a little puzzle for you. Picture this. A company wraps up a fantastic year on December 31st. A few weeks later, in January, disaster strikes. A huge factory burns to the ground. Now, here's the question. Should that fire, which happened in the new year, actually change the financial report for the year that's already over? Your first instinct is probably to say, no way, right? But as you'll see, the answer is way more interesting than that. Let's dig in.
And that puzzle brings us right into this idea of the financial time warp. So what is it exactly? Well, it's that strange in-between period, the gap between when a company's year ends, December 31st, and the day those financial statements are actually made public. It's this kind of twilight zone where the past hasn't been fully written yet, and the future can actually reach back and change it. Now, of course, the accountants have a much less exciting name for this. They call it events after the reporting period. And according to the official rulebook, IAS 10, we're not just talking about bad stuff like fires. It covers any major event that pops up in this window, good or bad, favorable or unfavorable. Okay, so let's get really specific about when this time warp happens. Let's look at a timeline. The year ends on December 31st. Simple enough. But that report, it's not actually finished and signed off for months. Now, you might think the cutoff date is way out in May when the shareholders finally get to approve it, but nope. The really crucial date, the one that matters, is March 18th. That's the day the board of directors gives it the official green light. So that whole stretch from the end of December to mid-March, that's our time warp.
All right, so we've got this window of time where things can happen. But how on earth do you decide what to do about them? Do you go back and change last year's numbers? Or do you just make a little note about something that's coming up? It can get really confusing, right? Well, luckily for us, there's one key question, a kind of golden rule that solves the whole mystery.
And here it is. This is the big one. You just have to ask, did the event give us new information about something that was already a fact on December 31st? Think of it this way. Was the seed of that event already planted by the time the clock struck midnight on New Year's Eve, even if no one could see it yet? The answer to this one question, it changes everything.
Answering that question sends us down one of two very different roads. If the answer is a clear yes, well then we've got what's called an adjusting event. And that means you literally have to go back in time and change the numbers for the year that just ended. The past gets an update. But if the answer is no, it's a non-adjusting event. The numbers for last year are locked in, but you still have to add a note to the report, kind of like a heads up about the future.
And look, this isn't just some vague guideline I'm making up. This comes straight from the horse's mouth, from IAS 10 itself. The standard literally divides these events into two clear buckets, the ones that give us clues about the past and the ones that point to the future. So now that we have our golden rule, let's put it to the test with a couple of case files.
All right, time to play detective. Let's open up our first case file. In this one, we're hunting for those adjusting events. The bombshells that force accountants to grab their erasers and actually rewrite last year's financial history. And case number one is a real classic. You'll see this one all the time. A big customer, one who owes you a ton of money, suddenly goes bankrupt right after the year is over. So what do?
Let's run it through our golden rule test. On December 31st, did that customer owe the company money? Yes, absolutely. That debt existed. Now, the bankruptcy that happened in January, did it just appear out of thin air? No. It was the final confirmation that this customer was already in deep financial trouble back on December 31st. It's new evidence about a condition that was already there.
So what's the verdict? Case closed? It's a textbook adjusting event. The company has no choice but to go back and change its books for the year that's over. They have to recognize that the money they were owed is now a loss. I mean, you can't just pretend that money was good to go when you have stone-cold proof that it wasn't.
Okay, on to our next case file. This time we're looking at those big, dramatic events that happen in the time warp, but surprisingly, don't change the numbers for the past year. But hey, just because the numbers don't change doesn't mean you can ignore it. The story absolutely still has to be told.
And this brings us full circle, right back to that puzzle I gave you at the start. What about that factory that tragically burned down in January? Let's apply the golden rule again. On December 31st, what was the condition of that factory?
Well, it was running just fine, business as usual. The fire was a brand new disaster that happened after that date. There was no pre-existing condition of a fire on New Year's Eve. It was a totally new event.
So the verdict here is, do not adjust. The company can't go back and change the value of its factory for the year that's already in the can. But, and this is a really big but, if that fire was a major deal, they have to talk about it. It has to be disclosed in the notes of the financial report. You can't just keep quiet about it. Investors, lenders, everyone needs to know this happened.
So, we've got our general rule. But IAS 10 actually points to two specific situations that are so important they get their own special treatment. You can think of these as the ultimate red flags. They are so critical to understanding a company's health that there are very specific instructions on how to handle them.
The first one is about dividends. Pretty simple, really. If the board decides to pay out a dividend after the year has ended, you can't go back and record it as a liability for that past year. Why? Because the decision was made in the new year. The second one, though, this one's much more serious. It's about going concern. And that's just a fancy way of asking, is this company even going to survive?
Yeah, think about this. If, during that time warp, management looks around and realizes, uh-oh, we're not going to make it, and they decide to liquidate the company, everything changes. The rules say this requires a fundamental change in the basis of accounting. That's huge. It means you stop preparing your reports like you're a healthy, growing company. Instead, you have to prepare them on the basis that you're shutting down for good. It is, without a doubt, the most dramatic financial rewrite possible. So, after all this, you might be wondering, why bother with all these complicated rules? Why do we even have this financial time warp? Well, it's not just to keep accountants busy, I promise. It's all about one thing, making sure that when we look at a financial report, we're getting an honest, trustworthy picture of what's really going on.
So let's zoom out. What's the big takeaway here? At the end of the day, these rules make sure that a financial report is a genuine snapshot of the company's condition on that specific day, December 31st, using all the information we have. It stops companies from conveniently ignoring bad news that was already bubbling under the surface. And it gives us crucial heads-ups about major events that are just around the corner. Ultimately, it all comes down to building trust in the numbers. Because when you strip away all the jargon and all the specific cases, this entire concept boils down to just one thing, that one crucial question.
So the next time you see a headline in February about some company's surprise success or some sudden failure, I want you to pause for a second and ask yourself that one key question. Was that story really written in the new year? Or was it just the final unwritten chapter of the year before?